Most people have heard about tax brackets, but very few understand how they actually work. A common fear floats around that earning more money could somehow push you into a higher bracket and leave you with less in your pocket. This single misunderstanding has stopped many people from accepting raises, working overtime, or starting side income. The truth is much friendlier than the rumor suggests, once you see how brackets really function. At its core, a tax bracket is a slice of income that is taxed at a specific rate. Most modern income tax systems are progressive, which means different portions of your income are taxed at different rates. The lowest portion is taxed at the lowest rate. As your income climbs into the next slice, only that next slice is taxed at the higher rate. The lower portions stay where they were. This matters because the myth of jumping a bracket pretends your entire income gets pushed into the higher rate. In reality, only the new portion above the bracket line is taxed at the higher rate. The rest of your income continues to be taxed exactly as it was before. Moving into a higher bracket may slightly reduce the percentage you keep on the new portion, but you almost always end up with more money overall. To understand how it really works, picture water filling a glass. The bottom of the glass represents your lowest income. As water rises, it passes through invisible lines drawn at different heights. Each section of water above each line gets taxed at a slightly different rate. The bottom water always keeps its original treatment. Only the water above each line is treated by the new rate. The glass never empties downward. Let us look at a simple example. Suppose a country has 3 brackets. The first slice up to 10,000 is taxed at 10%. The next slice up to 30,000 is taxed at 20%. Anything above is taxed at 30%. If you earn 35,000, only the last 5,000 gets the highest rate. The first 30,000 is taxed exactly the way it would be at lower incomes. A common mistake is to look at the highest rate that applies to you and assume it is your overall tax rate. That is the marginal rate, not the effective rate. Your effective rate is the total tax you actually pay divided by your total income. The effective rate is almost always lower than the marginal rate. Knowing this difference protects you from misjudging how taxes affect your real take-home pay. There is also a hidden risk in misunderstanding brackets. People sometimes turn down raises, decline overtime, or avoid side income because they fear moving into a higher bracket. But because only the new income is taxed at the higher rate, accepting more income almost always leaves you with more money overall. Refusing income because of a bracket myth is one of the most expensive misunderstandings in personal finance. A useful way to picture tax brackets is as a layered cake. Each layer is taxed differently. Only the layers you actually have are taxed. Adding a new thin layer on top does not retroactively change how the bottom layers are treated. The bottom layers were already there, already taxed at their own rates. Each new layer simply gets its own treatment as it stacks on top of the others. A second key idea is the role of tax deductions and credits. Deductions reduce the income that the brackets are applied to. Credits directly reduce the tax you owe. Both can significantly lower your final bill. Different jurisdictions have different rules. The point is not to chase every possible deduction. The point is to understand that brackets are only part of the picture, and a few simple deductions can quietly reduce your effective rate. A practical example helps. Imagine someone with a modest income who contributes to a tax-advantaged retirement account. That contribution may reduce their taxable income for the year. If it brings their total below a bracket line, part of their remaining income may be taxed at a slightly lower rate. The contribution does 2 things at once. It saves for the future and quietly reduces the current tax bill, depending on local rules. Beginners often misunderstand which level of government applies which brackets. In some countries, only the central government taxes income. In others, both central and regional governments apply their own brackets. The total picture is the combination of all of them. Looking at only one set of brackets can give a misleading sense of total tax liability. Always check the combined system, not a single piece. There is also a psychology angle. Taxes can feel frustrating, especially when watching a portion of each paycheck disappear. But viewing taxes as the price of public infrastructure, services, and stability shifts the emotional frame. The goal is not to resent the brackets. The goal is to understand them, plan around them legally, and avoid mistakes that cost you more than the taxes themselves. Calm clarity beats angry confusion every time. A simple practical rule helps you handle taxes wisely. Know which bracket your income currently sits in. Learn the bracket lines around you, both below and above. Track contributions to tax-advantaged accounts. Keep records of legitimate deductions. Estimate your effective rate at least once a year. These small habits replace fear with information and make tax season far less stressful than it feels for most beginners. There are things to avoid. Do not refuse income because you fear a bracket jump. Do not assume your marginal rate equals your overall tax burden. Do not skip filing because the process feels intimidating. Do not chase deductions you do not actually qualify for. Do not rely entirely on vague advice from friends. Tax rules vary widely, and decisions based on confident-sounding rumors can be more expensive than any extra income. A better habit is to spend a small amount of time each year understanding your own tax structure. Read a basic guide for your country. Check official sources. Use a simple calculator if helpful. If your situation is complex, consider speaking with a qualified professional. The cost of an hour with someone knowledgeable is often a tiny fraction of what you can save or avoid losing through small smart planning. Over the long term, understanding tax brackets quietly improves many financial decisions. You handle raises with confidence. You time contributions more thoughtfully. You select investment accounts that suit your bracket. You avoid panicked, last-minute moves at the end of the year. The result is not just lower stress. It is also better financial outcomes spread across decades, made possible simply by knowing how a few layered slices of income are treated. So here is the short version. Tax brackets divide income into slices, each taxed at its own rate. Only income inside each slice gets that slice's rate. Moving into a higher bracket does not reduce your existing income's treatment. Marginal rate and effective rate are different. Deductions and credits can reduce taxes legally. Understanding the structure removes fear and makes better financial decisions much easier across your entire life. If you remember nothing else, remember this. A raise will not make you poorer. A bracket only affects the new portion of your income, not the rest. The fear of higher brackets has cost many people meaningful financial growth. Learn the basics for your country. Use available tools. Plan ahead. Then take every legitimate opportunity to earn more, because the tax system is structured to leave you with more, not less.